Hi, everyone. Thanks very much for joining us for this podcast today. I'm absolutely delighted to be here in person with Mark Baker because we spent quite a bit of time working together over the last few months on Ocorian's new global asset monitor. So, hi, Mark, for real. It's good to see you in person rather than behind a screen. And thanks so much for collaborating with us on this project. Um, just before we go into a bit more about your findings, can you tell us a bit about yourself?
Yes, of course. Well, first of all, thank you very much for having me here. It's been a really fun project to work on, and I am excited to share more of our findings with our different audiences. So my name is Mark Baker. I'm started my professional life as a analyst and a fund manager, which I did for a few years, working mainly in emerging markets. But I kind of learned in that process that there are so many stories that the big numbers in finance tell us, and those stories can help demystify what's quite a complex industry for many people to understand. And it's reports like the Global Asset Monitor for Ocorian that help kind of demystify that complexity in finance. And in particular, we're bringing the stories from the private assets, which are even harder to understand for many people. Um, and then even for more initiated audiences, we often find that content like this helps them to sort of have conversation starters with their own client base, and use the insights that we produce in their prospectuses or in their client presentations.
I'm interested to hear you talk about stories because there are a lot of stories in this report. One of the key ones of which was around the trends over recent years in both public and private markets. Can you talk to us a bit more about kind of what you found?
Yes, of course. I mean, we've tracked the 8 largest asset classes in the world, so covering listed equities and listed bonds. And then in the private markets, we are mainly using Preqin data with some own analysis of our own to track what's happening in private equity, in private debt, in infrastructure, and the sort of private real estate fund world. And the numbers are really big. And it's trying to put into context what the size of those numbers really mean. So we discovered, for example, that at the end of 2024, the total size of the world's as an investable asset base, if you like, was a massive $246 trillion. Not only that, but it had gone up by 11% in 1 year alone. That's around $25 trillion. If you think that the UK stock market's worth about just over 3 trillion, that's about 8 UK stock markets in 1 year. It's enormous amounts of money. The global economy is about $116 trillion. So more than double the size of the global economy is the global investable asset base, if you like.
Yeah, I was just thinking, what does that equate to in GDP terms, or country-wise? But it was a pretty substantial one with those kind of numbers. Um, and I think one of the findings that we talked about that you pulled out was around this concentration and fewer stocks taking a bigger share of things. How's that come about?
Yeah, I mean, it's a really important trend in listed markets. So, I mean, first of all, let's just quickly kind of think, how does that 246 trillion break down? The largest chunk is listed equities. It's about 116 trillion or so. Um, but the bond markets are also big, and and about 95% of that sort of total global asset base is in the listed markets. The other 5% is in private assets, but there's a very important 5%, which I know we're going to talk about a bit later on. One of the reasons why private assets are important to look at is because of some of the trends that have been happening in the public ones. And that concentration has actually become a problem in listed markets today. So about 15 years ago, the 10 largest stocks on stock markets around the world were worth around 7% of the total market cap. Now it's almost a fifth. And I think 4 stocks alone are worth about 10% of global market capitalization. So what that means is that if you buy a global tracker fund, for example, you're actually a lot less diversified than you might think you are, because the fortunes of your fund are heavily dependent on what's going on for just a handful of stocks. And almost all, I think today, just one of the top 10 is not in America, and almost all of the others are tech stocks. So It is possible, of course, it's possible to construct a very well diversified portfolio in listed equities. But if you just bought a tracker fund, which people think of as the most diversified way of getting exposure to equities, you're actually not as diversified as you might think you are. And that is where other forms of investment start to look like an interesting addition to your portfolio. And I think it's where private assets begin to play a role.
Yeah, I mean, we saw a very real example of it recently when one of those big tens took a big hit, and one day, what was the market down by 17%
It
or
was
something?
it was very large, and it was Nvidia, of course.
Yeah.
When DeepSeek, the little Chinese upstart, came out saying, "Well, our AI model is almost as effective as some of the biggest ones out there, and we've done it with old cheap chips and a very small investment, a few $1 million." That was quite a shock to a market that has been spending tens of billions building this sort of new technology out, and sort of upended some of the assumptions that people are making. And I think the other thing that we saw, not only did Nvidia lose, was it half $500 billion or something crazy in a day, but also we saw a lot of the other big tech stocks fall as well, which highlights that point that we are making, that they're quite closely correlated, and so made a significant dent in someone's global equity portfolio.
Yeah, it did really highlight that concentration risk to me when we saw those figures playing out over the last couple of weeks. And I guess that's probably why people are turning to private markets more. And private equities had a huge successful run over the time that the Global Asset Monitor covers. How have do private markets compare in terms of diversification?
Well, obviously, they are still smaller, and the private markets in total around 5% of the global asset base. But the diversification point is an interesting one. They tend to be more geographically diversified and have a greater sector diversification as well than currently we're seeing in listed markets. And if you think about it, that makes sense, because what are private equity houses mainly investing in? Well, they're looking for companies that they can help transform their business success, either through combinations with other companies, through management change, through application of new, more efficient techniques, whatever it might be, to add value to companies that are therefore typically in that sort of small to medium size enterprise. And it's those small and medium enterprises that have really struggled to get any attention on the stock market in recent years, and are happier in many cases to be in private hands, uh, and value the additional expertise that private equity ownership can bring to them. So we see from a sector point of view, for example, I think in the public markets, tech sector is worth about a third of global market capitalization right now. It's significantly less than that in private equity, around about 1/6 if you exclude the diversified funds, which will also have some tech stocks in them.
And how has the private markets performed over the period of time that you looked at?
So there's a difference between performance and the size of the market, because the size of the market is a function both of capital inflows and of performance. So if we just look at performance alone, an industry trade body, the CAIA, shows that private equity returns have been about 5 percentage points faster than the returns that you're getting on public markets over the longer term since the turn of the century. And since they're talking about 11% per annum returns, that's actually very, very significant. It's almost twice as fast.
And how about on a regional basis? Did you come across differences from the US, from Europe, from the UK, from Asia, etc.?
I think it depends a bit on where which assets the private funds are investing in. So, for example, in infrastructure, that's been the fastest growing asset class in private assets over the last sort of 10 years or so. And it's now similar in size to the real estate funds and to private debt, about $1.3 trillion. Private equity is still the biggest. But if we look at that kind of 6 times growth in the last 10 years in infrastructure, where's that come from? And it's really been very much a global phenomenon. And the fastest growth in infrastructure has been in Asia and in Europe, and it's followed by North America. Um, North America is still the largest, but Europe's quite close behind. Now, why is that? What's driving it? And actually, those trends are trends that we're seeing played out in many parts of the world. So digitization, the growth of data centers, fiber networks, and so on. That's crucial part of the infrastructure build out. Decarbonization, obviously the whole renewable energy push, grid storage, and generation, and even demographics. If you think about the infrastructure that we require to cope with the aging population, that's also something that you're seeing come out across the world. And stretched government finances in many parts of the world also require the addition of private capital to help make all of this happen.
I guess that's been a real sort of new thing that you wouldn't have seen 20 years ago, but is now very much run of the mill to have these public-private partnerships.
Yeah,
Big infrastructure projects.
absolutely. And investors really like it too. If you think of what a pension fund wants, then they need long-term stable returns, often with inflation protection built in, and really kind of predictable cash flows that come from infrastructure. Infrastructure assets aren't very liquid, but pension funds don't mind that because they're looking on a sort of 30-year time horizon. So they're quite happy to lock in for the long term, and they behave like very stable bonds effectively. And if we look at back to that whole sort of regional point, in private equity, North America obviously had a head start. So they kind of, the industry really started to take off in that continent. But the market there is still 4 times bigger than 10 years ago. But look at Asia, it's now 8 times bigger than 10 years ago. So it's been growing twice as fast. And that is a combination of, obviously there's performance is an element, but it's the fund, it's the fund inflows, it's the growth of the sector, the opening up of that continent, and the finding of more opportunities for investment. Europe and Latin America have lagged a bit behind. I think in Europe, it's probably factors like higher regulation, more fragmented markets, and probably a less dynamic startup ecosystem than in places like North America that have accounted for Europe's relatively slow growth in private equity.
Well, it's going to be fascinating to see what happens over the next 4 years in America and
Yes.
how the current political situation there is going to change positively or negatively on that growth percentage, and whether they'll catch Asia up again by changing some of their policies.
Yeah, who knows? I have not got a crystal ball to try and figure out what 4 years of the new regime in America might deliver, but I'll be excited to see.
Yeah, well, let's come back in 5 years' time and we can check and see whether we were right. And I think the Middle East is an interesting area as well, and how kind of sovereign wealth is really making a big mark there. Did that kind of come through in some of your findings?
I haven't really looked in detail at sovereign wealth funds, but one of the things that is coming through in the Middle East is the rise of the family office. So actually that's something that's played out across Asia as well. I know Ocorian has quite a significant family office support business, and the rise of a wealthy, not just of a middle class across those regions, but in particular of extremely wealthy families and individuals, has been very important for the development of private capital in those regions too, because those families and those individuals can look beyond public markets for that kind of long-term patient capital that's required for these investment opportunities.
Yeah, I mean, that's a trend that we've seen a lot of in our family office business at Ocorian, where the people are becoming much more of an institution and taking a much more professional approach to running their family office, with all the governance and the infrastructure that supports that investments of that kind of magnitude. So interesting that you're seeing that coming through in the report as well.
I think so. And if you think about how like succession planning and inheritance might work through a very large family office, actually increasingly it does have to behave like a company with, as you say, all of that fiduciary responsibility, because anyone who's watched Succession on TV can see how big a bun fight might emerge, and if there is not sort of suitable management of those assets and thinking about the next generation.
Yeah, let's avoid that that at all costs. Thanks so much for coming in to talk to us today. It's been really great to talk to you in person and find out a bit more kind of behind the stories behind the Global Asset Monitor. I know that we're looking at further issues coming up later in the year, and we're already talking about Asia-specific ones, so watch this space. If you would like to know more, please click the link in the comments here, or go to our website where you'll be able to download a copy of the full report. And of course, wherever you are within your life cycle of your investment, we can help.